right, so now we know what a company is, right? Company, we talked about LLC, talked about S Corp, talked about C Corp. I mentioned sole proprietorship, right? Those are all companies and things and ways you make money. S Corp, no real protection. LLC and corporations, you are protected. So if someone sues your company, they can't really get through to you most of the time. I mean, it's called piercing the corporate veil, which is very rare.
It's more challenging to get to you.
Yeah.
So can you buy a separate liability like coverage for your S corp then? That's going to be
so
cost effective for you.
So once you have an S corp, it's already covered. Your liability is already, you're good. You're good. And so if you have an S corp, so again, selling wine, someone like gets sick off of wine, they sue you. Not suing you, they're suing your company.
The LLC, you have no liability.
Or S corp, either one. They're all the liabilities are all limited on S corp, C corp, LLC.
Limited to
the company and not yourself. So there's no personal liability. Well, there's limited personal liability. Mm-hmm. And so we have all these companies, right? And so you mentioned the topic of the day is like about IPOs.
Mm-hmm.
So starting a company, fairly simple. Get a lawyer, get an operating agreement. Goes to Secretary of State. I usually recommend Delaware with New York law because it's the best. And so now you have a company. Great. You have an LLC. We're selling wine. Have an LLC. Now all of a sudden we have investors come, right? Okay, hey, maybe we all talk to our cousins and our uncles and aunts and whatnot, and we want to say, okay, wine business is growing on crazy. Let's, you all want to invest. You can invest in an LLC, no problem. Right? It's fine. You can do it. Invest in an LLC. They invest in us, and we're moving. Now we're like, oh, now that we're knocking on the door, some of the big brands want us now, right? But they're like, whoa, we're not investing in an LLC. We will only invest if you're a C corp. So you see a lot of smaller companies that get bigger accidentally turn into C corps because they start attracting big money. Once you have big money come in, now you're C corp, now you have a board of directors. And this is where the control piece comes, because of the board of directors, they can actually start dictating what you do as a CEO. Because remember, companies are people, right? Like, who said that? Was that Romney, or who said that? I think Romney said that.
I think it was Romney.
Yeah, so the companies are people. So they have their own social security number, which is called an EIN, direction of the CEO and the board, right? Depending on what structure you have. So, we get more money, and then let's say a big, Cavassier comes by us, or buy a part of us, right? And then, okay, we want 4 board seats out of your 7, we want control. First thing they're gonna do is fire CEO. Guess who the CEO is? One of us, all right? Mm-hmm. Now we have our percentage, and we're making revenue, whatnot, we have our shares, but now we just got fired by the board because we want some investment, right? And then that's what you gotta be careful of for a C corp. But now, so they fire us, put in somebody that's done this for 20 years, throw a bunch of debt on it, build it up, grow it up. Now we're buying other wine companies, and now we're making $500 million in revenue every year. It's almost time to IPO. All right, so that's their goal, because once you get to that stage, it's just about making money.
What does IPO stand for?
Yeah. Initial public offering.
What's the benefit of it?
Right. So. Remember, we started a small little company, and then we got an LLC, and then we're like, okay, we're going bigger, we're into C corp. Once you IPO, it's all about having access to capital. Right? So capital, right now, debt is cheap. What that means is you can go to a bank and probably get a loan for like 4.5%, 5%, something like that, right? Super cheap. Versus in the 80s, that loan would be closer to like 9 or 10%, right? Which is kind of expensive because everything moves in relation to interest rates, and Federal Reserve controls interest rates. But it's a deeper topic. We're not getting into that right now.
That'll be another day. We'll say October.
But high level, interest rates control everything. Mm-hmm. So that dictates how expensive money is, because, like I mentioned, all companies need food, and the food companies use is money. Right. Mm-hmm. So it's all about growth, money, and interest rates dictates that, right? So we're all right. We don't want any more debt, because if you get too much debt, then you look kind of risky, right? So now we're growing. We want to go on. It's called have an initial public offering to the public. So we want to sell. If we have 60% of the company, Cavassier has 40% of our wine company. We say, okay, we're going to sell 75% of our shares, collectively to the public at some price. Now the price can be, let's say, price $20 a share, right? and it's all the buzz. So they go on a road show, they figure out, okay, who wants to buy this, and the big money gets in early before the public gets in, and so it's all about relationships, and they try to figure out, will this thing actually work? Do people really want to buy our wine company, right? And people being us, right? That's what the stock market is. Stock market is a place where you buy and sell stocks. So we say, okay, we think it's profitable. We think that we'll make money because we need more money to grow. So we're trying to raise capital, and we don't want to raise it with debt anymore. And because we own 60% and they own 40%, we collectively giving away 75%. Everyone's getting the bag because that means we're selling our shares for cash, right? So okay, so we're gonna sell for cash, and we all own 5%. In this room, everyone owns 5%. So if, we IPO, everyone may have just made $50 million, $100 million, something like that, because we're selling our illiquid, you're selling your shares to the public at $20 or $30, whatever it is, right? So now once they have it, then. So now, we do a road show, something called an S1. But an S1 dictates all the terms, and okay, this is who we are. This is why we're going public. This is what we need. This is our risk. This is our business model. And you can go, and S1s are public, so you can go and read. And I believe this is a new rule where you can actually read S1s. And I kind of do it for fun. Like WeWork, they have a S1 that came out, and and it talks about their business model, what they do, how they're making money. You have to lay out every single thing you've done, like ever, right? Because they want the public to know exactly what they're getting into. If we're going to invest this money, and typically, we may buy 10, 20 shares, like we being individuals, but this money is going to the hedge funds. This money, these shares are going to the big banks, to the people who are controlling your money. They're the ones buying these IPOs, right? These IPOs. So, are we IPOs? IPO day. We're valued at $20 a share. Typically, I don't know the exact percentage, but I would say above 50% of IPOs increase once they go public, because they're so excited. It's called being oversubscribed, meaning we're only selling 75%, but we have 90% of people want this stock, so it's like crazy. So as soon as it goes public, we have it at 20. We're guaranteed $20, but as soon as it goes public, now it's shot up to 25, 26. Exactly. Right. So that means the demand's
this is
higher.
what happened to Pinterest when they went public with their IPO, and Zoom.
Beyond Meat.
Beyond Meat was a huge one that it happened to when they went public with their IPO.
Can I ask a silly question?
Yeah, sure.
So you said, okay, your example was, okay, you had 60, and then the other
they had 40.
Had 40, but then you sold 75%. Did you keep your percentages of 60-40? Is that
so it just depends, right? So it depends on what you have in your operating agreement and what you negotiated. So hopefully you had a good lawyer and they said, okay, well, we're doing 75% of all our shares. That means you got 75% of your 40, I got 75% of my 60, and we're good. And that because it's all about majority, right? Because if you sell. We sold 75% of our company, and we each, let's just say I have 15, they have 10, right? And everyone has 75, but 75% is individuals, right? So I still have the majority because I own 15%, so I still have control.
Okay. But you have to set that up
before you go public.
And so this whole pricing thing, right? Remember I said that the banks valued us at $20, right? So the bankers, it's called, they underwrite this deal. So they underwrite it. And that means that they're funding it. They're the ones preparing everything, putting their money up, buying some shares. They say, hey, it's a great stock. They're going on a road show and pitching it. Then it's okay, $20. Now it goes. They actually get more money because they all bought shares too. They bought at 20 or 18 or whatever discount. Okay. So it's kind of a tricky thing because the investment banks, the Goldman Sachs, the Morgan Stanleys, JP Morgan, Cities, whoever. They now are like, oh, it's $20, but the stock goes to 35.
35, right.
And as an owner, I'm like, wait, I just sold my share for $20. And now you tell me it's 35, and the banks were like, well, we mispriced it. Right?
Okay.
And that's like a tricky dance that you got to worry about as a consumer or as an individual, right? This is relevant for you because once you all get with a wealth manager, not a financial advisor, a wealth manager,
that's different.
Big difference. Who's at one of these big banks? They say, when I was on the desk at Goldman, we would call. We have, I think, there's about on average probably 7 to 10 IPOs a week, on average about. depending on the year. I'm on the desk, hey, let's call our top clients. Hey, we have an IPO, it's oversubscribed, we get it at 18, sell it for you tonight at 19. Once it pops, we project it to pop to 27, you sell, or 30, 30. And so you say, okay, well, I'll buy $1 million worth. 5 minutes, it goes to 30, you just made $500,000. Sell off, and now you're happy. Mm-hmm.
So
and that's how that game is.
So after it goes, because Bitcoin did similar.
Right.
It's been upgraded like 16 grand, whatever.
Mm-hmm.
Now it's like, I don't know, I haven't checked in a while, like 6 or something.
Mm-hmm.
I think it might be
So
like 10
then
or
what
11.
happens to, like, you just lost all the money?
So did you sell or did you hold?
I had sold most of it. I sold what I put in, so
Right.
I'm playing with it.
Right, so that's the difference between realized gains and paper gains. Right. So if on an IPO, when your wealth manager calls you and says, hey, we're gonna get you in and get you out. Because we know that once it goes up 5, 10, 15, 20, sometimes 50%, sometimes 100%,
Right.
one day, anything over 10%, I mean, you made, 10% in 5 minutes, you put in $1 million, you made $100,000 in 5, you get out. I'm not trying to hold.
A good example of that is when Beyond Meat first came out. I think the stock was somewhere between $30 and $40 a share.
Yep.
I bought it when it was 60 something a
Yep.
share. At one point, it went up to like 120, 130
yeah.
a share.
Yep.
Now it's on the downward end. At 80 a share. So if you sold when it was at 130 a share, you made a good profit.
Right. But the prop, so this is all about balance. It goes
Right.
into like a basic investment. It was really life advice, right?
Right.
So when I was an undergrad, I was like nerded out and I read a lot of books on trading. I was like trading some stocks and whatnot, and learning how to trade. They teach you that the two most important things to take into consideration: fear and greed. Right? Because if you're too fearful, you're never going to buy. If you're too greedy, you're going to hold it to you 130 and goes all the way back down to 10, and then now you're kicking yourself. So, but then if you bought at 30, you sell at 60, you made 100% profit.
Right.
But then it goes 120, you're like, you're mad.
Right.
Now
And
you're
then you're
mad,
mad. And then you're mad.
But that's being greedy. Because you still made, so that's why I call it taking some money off the table gradually. Get your principal back, make your returns, and not just buy, sell, all.
Play money.
Exactly. Let it go,
Right.
do what it said, then hope for long term. Depending on, again, if this is an IPO, the strategy usually is, unless you are in love with this company, you think it's the next Disney or something crazy, then hold it for life. You never want to sell.
Not
But
the next Disney.
if it's like, if it's something like Beyond Meat, I'm partial. I'm not a big fan of Beyond Meat, but
I mean, it tastes okay.
no, it's decent, but it's.
I like
Keeping it right, it tastes right.
Yeah. Well, so I mean, I like the
pea
product.
protein.
Yeah, I like the
It's
product.
protein. So they figured out how to get protein and extract it from vegetables. So when you look at your vegetarians or your vegans, who are people who can make the assumption that they're protein deficient because they're not eating a meat source, this is another potential option for them. So yes, look, I'm not in love with anybody. My thing is that if you look at a company, and this is me, and I will totally admit that I am a novice in this regard. I try to look at, okay, what's a company that you can see, and you can see it making strides in terms of eventual growth.
Yep.
So when I look at a Beyond Meat who's made a deal with a Dunkin' Donuts, so they have a vegetarian burger for breakfast, I'm like, that's interesting. I'm less concerned that your stock value is dropping because I see the potential for growth. Or an Impossible Burger, who is not public yet, they're only privately owned, who's making a deal with
Burger King.
I was going to say the Whopper people. I don't eat Burger King. But they're making a deal with Burger King, and so you look at it as they're the first ones, right? So they're the first ones who are making deals within the fast food industry. So you're just like, that's a company that I need to think about. So I look at it more so, who is someone long term that after 15 years I can say, we've had a good relationship. Thank you so much for your services, and I'm out.
What website were you following or Newspaper. What were you reading when you?
So I literally just look at articles. So I'll look at stuff in Forbes. I'll look at stuff on Yahoo Finance. I'll look up things about the various companies. It's like when Zoom went public, I can think of a ton of companies offhand who use Zoom like they use Skype for their video conferencing. So that's a company that goes public where I'm just like, that's someone who I can see a long-term relationship with. So I'm very much so not a trader, because my thing is like, no. I'm all about the longevity. If I'm in it with you, we in it to win it. We are going to grow together. So
that's the mentality.
Right. And so for my mind, it's like, okay, so who is someone that I'm looking at them constantly building and seeing how they can participate in the marketplace? So like before the meeting started, I was talking to y'all about Zelle. I'm like, I need Zelle to go public, because every major bank in this country uses Zelle as a way for everyone to get quick pay. It's like, how do you do Chase quick pay? How you do quick pay with Wells Fargo's? How you do quick pay with like MTB Bank, which is a very small bank in Maryland. But they use Zelle too. Right. And so I'm just like, all right, I'm gonna sit here and wait. And when you ready, I'm ready, boo.
Are you reading that stuff every day? Like going on Yahoo Finance forums every day?
Like every other day. Like literally, he and I will have a conversation in the morning. I'll say, hey, I saw this company, or I saw this company. Or he'll be like, you need to read this. Okay, fine. That's aggressive, but sure.
So I get 7 publications every morning that I read. So I get
Okay,
all
right. So again, I'm gonna put the hold on it. DK is different. DK is different. My cousin is different. Like his day starts at a different time than most people who are like normal. Like when I'm not working and I wake up late, like him not.
Because so I get my macroeconomic news from the Economist Espresso, right? So you get all the news about what's going on in the world, right? Which shapes markets, which gives you the currency news, because I follow currency, make sure you know where the dollar is, what the interest rates are. That depends on how the rest of the world's doing, right? So then I have Deal Book, that's the New York Times deal page, so that's all the M&A going on. M&A is mergers and acquisitions, right? So are people buying companies, are they not buying companies, are they selling companies? That tells you the health of the economy, right? So that's more like not international, but more like a macro, U.S. macro type of deals, right? Deal Book from New York Times. Then I get Pitch Book. Pitch Book is my private equity source, so that tells you all the private equity that's going on. So all the deals that are flowing, from a Series A and beyond, right? So all the PE firms from small to large, where they're going, what they're doing, and it gives you updates, right? Then I have Robinhood Snacks. Robinhood Snacks, that tells you all about what is going on in the stock market, like specifically like the IPOs, who's doing what, like all the gossip. It's kind of entertaining. It's written for like millennials and whatnot. So it's interesting. It tells you all the major indices and where they are.
So one particular publication that I didn't think was going to be useful, but is local here to Chicago, is Cranes.
Crane's good.
And
Cranes is good.
Prime example, like I think I text both Marcel and you, and I was like, Barney's is going bankrupt. Now, let's be clear. I am not in Barney's every day. I've probably been to Barney's a handful of times because I am not a Barney's money type of person. I'm a little too cheap for Barney's. But to see a staple like that in the retail industry that is filing for bankruptcy and closing stores, they're going to close their store here in Chicago. They're only leaving like a handful of flagship stores open. I said, oh shit, we're about to go into a recession. Because one of the things that you look at when you're looking at a recession, like one of the last things that you see are when retail companies start shutting down. So I was just like, this is real. And that was in Cranes, and it's like, I'll see stuff from them in my email. I'm like, oh yeah, whatever, okay. Yay, there's a marketing event. Ooh, I'm not going to that, but that's fine. But yes, he's had his hand raised for a long time.
So as a millennial, I have a lot of friends that believe you have to have either this like magical wizard or like $50,000 to invest in publicly traded companies,
Yeah.
which is not true, as you all know. What apps or institutions would you all recommend to invest in these publicly traded companies?
Robinhood and ETFs. Robinhood is a free app. You trade. They actually going public soon. So, keep your eye out on them. They're going public. So they have zero commission.
Right.
They're one of the first companies that have zero commission trading. Because usually, before Robinhood came out, I was trading on Scottrade. And Scottrade had like $7 commission, and then Scottrade got bought by TD Ameritrade and kind of went up a little bit. Then Robinhood came in and said, "No, we can do this for free. We're just gonna steal all your data." but you can trade for free. So I'm like, "That's cool. You can have that."
I also like Schwab because Schwab, you can literally open up an account with them and use that account as your trading account.
Yep.
So I have it set up where every month I get a certain amount of money from my checking account put into Schwab. And then at that time, I use that money to either buy like random stocks or I just buy the market. And I do that every month because I like compound interest and it makes me feel warm and fuzzy.
Yeah.
You said Schwab, like as in S-W-A-B?
SCHWAB, like Charles Schwab. So, I mean, I love Robinhood, honestly, because it's like I can, any moment of the day that I want, I can see what stocks are public, see what's happening with the stocks that I'm investing in. And I really do like their little email that they send you every so often about their Robinhood snacks. Because they'll tell you like, oh, this company's predicted to go public this year. This is this and this is. And so it's like a little update that you can get that's quick. That's not a 15-page dissertation about the company that I should care about, but I don't.
Yes. So another thing I have is CB Insights. That's number 5. I use CB Insights, and that gives you news on the startup world and like early stage private equity and venture capital. So I use that. I read that. And most of the time I skim just the headlines, just because if I'm reading it, imagine you're reading it every day. You dedicate 30 minutes to 60 minutes every day to read, to skim. You get this compound knowledge, right? So now, I read this somewhere. Let me go to my email and figure out, what's going on. So I'm familiar with it, and that's that's the goal for me, just to be familiar with the overall trends. So when I'm in meetings, with these executives or CEO, who my clients, whatever, I know exactly not just what's going on today, but what's been going on for the last 3 to 5 years, because I've been reading so I know and what to expect and how this turned out, and you can speak very intelligently about companies and whether they're public or private or just the gossip on Wall Street. So.
And I'm sorry, this might actually be a silly question. What does it mean being private or public, going private?
Yeah, that's not a silly question at all.
Not a silly question at all. Totally fine.
So a private company is you can be an LLC, a C corp, S corp, a sole proprietorship. Whatever. You don't have to be anything. You can be a company, right? It's private. That means you're not selling shares to the public. That means you're not disclosing. You're not registering with the SEC. You don't have an S1. You're just like you're private. When you go public, when you IPO, the SEC is like, they come in your crib and just gut everything. We want to know where all dirty drawers are. We want to know, have you, when you take a bath. Security exchange. Yes, they're federal regulators that make sure that everyone's trading fairly. They're the ones that prosecute on insider trading and whatnot. So they are like the watchdogs. They say, okay, if you're going to trade to the public because you want the public's money, we got to make sure y'all legit. We want to make sure that everything's straight. We want no mishaps. We want no dead bodies. None of that. Right. So that's what the SEC does. And so when you go public, you start. Remember that 60-40 and 75% we sell to the public. That's what that means. Is that we want public money because we want to raise more capital to grow larger. That we want to trade on the New York Stock Exchange or the NASDAQ or one of the exchanges. So everyone can buy us. So anyone that has a trading account can come buy us and fund our company, and we can grow even larger. So that's when you're publicly traded, you're on some kind of exchange, and anyone can buy you. When you're private, you can hide. You can have as many dead bodies as you want. You can hide.
No one knows.
No one knows. Exactly.
No one knows.
Exactly.
You spoke about insider trading. You can't do that publicly unless you're in Congress, right?
You have to wait for him to put the wine glass down before you drop the bombs.
I'm not gonna speak on that. I may be running one day. I may have friends that run soon, so it's illegal. You can't do it.
Bad. We've heard stories that it's bad. That is what we say.
Yeah.
Don't do that. Just say no.
We used to go there just like, it's okay.
We'll just say
know,
it's bad.
Again, I'll give you the lawyer answer. It depends. Did that answer your question about the private?
Okay.
So, you mentioned the difference, or that you want a wealth manager as opposed to a
financial advisor. Yep.
Can you
Unpack. Yep. I'll unpack that a little bit. So, financial advisors typically make, and this is generalizing, right? I don't want people to watch this and be like, oh, what did you say? Generalizing. By and large, financial advisors make money the more clients that they have, right? And so it's a volume game. So they're trying to get everyone who can give them 10 grand to give them 10 grand, right? And that's where they make money. They got machines and people to figure out where to trade. They're trying to grow their pie with more people. Wealth managers, they're very specific and particular about who they actually let into their portfolio. So you gotta have a bag. You gotta have 3 million, 5 million. At Goldman Sachs, it's 25 million, 50 million. And now they say 25 million. Like we'll like talk to you. Like you really gotta be, on your way to 50 million liquid. Not like 50 million in houses. No, liquid, like liquid. So that's because they make their money by making you money. And that's why I say you want someone whose incentives are aligned with you, right? Some of the other banks, I think it's like 1 million to 5 million, liquid. You can get a wealth manager, because a wealth manager has, 15 clients. A financial advisor has, 1,500 clients.
Right.
If they're good. You know what I mean? Some the good ones do. The bad ones have like 100. Basically, they're not going to return your phone call. You can't call. Whereas you have a wealth manager, they're managing your 50 million and 10 people's, 50 to 100 million or 500 million. That's, you can call them anytime, but hey, what's the money doing? Every day if you want. You don't have the access to financial advisor. So that's why I say, in this day and age of like robo trading and artificial intelligence and the apps you can use, if you have a goal of reaching 11%, returns every year, and a financial advisor takes 3 to 4% of that, you gotta make. How hard it is to make 15% on the stock market? It's hard. If you do that consistently, you will be a billionaire 100 times over, and you are. That's why it's called hedge funds. They can do that consistently. But so a hedge fund pulls together money and trades on a specific strategy, whether it's through like algorithms or the traditional sense, like the old nomenclature of a hedge fund was to hedge against like your downside risk, right? So when we're in a recession, hedge funds, they do the research in overseas, in Spain. They're in they're buying companies in Iceland. They're doing like they're buying trucking companies in China or some crazy crap, right? Because they have the manpower and they see things differently.
So you have to have a certain amount of liquidity,
money to
really get into a hedge fund.
Wealth managers hire or invest your money into hedge funds, right? Because hedge funds, it's so imagine you had like a secret formula where you knew like, okay, I know technology like the back of my hand, right? And I know that certain AI stocks are going to pop, and I'm like 80% or even 70% right on which ones are going to do 100%. Returns, give you 100% returns. You can start a hedge fund, everybody and their mama gonna give you money, because if you can accurately predict when a company is going to make 20%, 30%, 40%, you're a genius in the eyes of the market, and they would give you, pension funds will come give you 100 million. I know hedge fund managers that, like I personally know hedge fund managers that turn away hundreds of millions of dollars. Like we got a good strategy, but we don't want to like mess it up. Because when you get too much money, you start moving markets, and then you create your own strategy, and it's like that's why hedge funds go bust. But it's a different topic. But yes. IPO? No. Nope. So every country has their own stock exchange, right? So in America, we have like the NASDAQ, we have the NYSE, New York Stock Exchange, we have S&P 500. They have all kind of different exchanges. The DGIA, it's Dow Jones.
Yes,
Dow Jones.
Dow Jones. Thank you. I was like, wait, the D.
and so.
Did not mean that. Sorry.
Freudian slip. So it's like in America. Then you have like. So like in Canada has the CSE, right, the Canadian Stock Exchange. Then you have the FTSE, right. Then you have the Nikkei, right. That's in Japan. So you have every country. Well, almost every country has their own stock exchange where you go public.
But when you're public, you go public with just that country's not. Like Uber's public here, but
Yep.
you get other countries as well.
So you can be public in more than one country, yes. Because think about it, we have 60%, 40%. We can just say, all right, we only going to give America like 40% of our, and then we want to go to Canada, give them 20%. So we can IPO both places. Not the smartest thing to do, but there are companies that do that. But if you want exposure to international companies, it's called over-the-counter receipts and OTC or something. Yeah, OTCs, and you buy or ADR really, and you buy derivative that's based on the stock movement of another company in a different country, which is.
Unless that Unless that company is already actively on like our New York Stock Exchange, like a company like Alibaba, who Alibaba is a Chinese company,
but they went public.
They went public in China, but they are actively traded on the New York Stock Exchange. Right. They're like the Amazon for China.
Yep.
So to speak.
So what would be the benefit of doing that? Just
doing what?
Having actually going IPO on the foreign country, because you can be traded anyway. I mean,
it depends on like
foreign,
company exposure. You want to be traded in New York or in America at least, because it's the most robust economy. We're the like global capitalist leaders, right? So everyone's trying to get into trading here, but then that comes with a lot of SEC regulation, right? Canada, cannabis is legal, 100% legal. So cannabis companies it's a GTI. Cannabis company it's in America, but they went public in Canada because it's public, because it's legal there, and they couldn't go public. Right.
So when they do, though, in America.
Oh,
it's gonna be amazing. Sorry.
I mean,
You don't want to be on like the beginning of that.
Maybe.
Depends on the company.
Maybe.
It literally depends on the company. The cannabis market, I feel like it's pseudo-saturated almost, but
not pseudo. No, it is. The prices are different.
Yeah, but it's like there's a handful of cannabis companies that have been fairly consistent in terms of what they've been doing. Like one of the companies is Canopy Growth. There's another one, GW Pharmaceuticals. Yep. I like GW Pharmaceuticals because they look at using cannabis in terms of medical treatment. So they've actually got a new treatment for epilepsy, but it's a specific type of epilepsy related to like a neurological congenital issue that is very rare, but it's still present. So it's a handful of companies that have been consistently doing well. I'm gonna stop talking because he had a question and had his hand raised for a while.
Last point. Did you know who owns, I believe, the majority of Canopy?
No.
One of the large beverage corporations. I think it's Constellation.
Oh, that's exciting.
Yeah. So that's so with private companies, you don't know who the real ownership, where the ownership interest is, but the larger ones, they want people to know. So this in cannabis, the larger corporations are starting to buy these bigger cannabis companies. So, and they already have the infrastructure to go public. They already have the lobbyists. They have everything, ready. So it's only a matter of time. To your point, it's a matter of time. You want to get in, but it's just like any other, goods, consumer good. Yeah, I believe the growth CAGR's compound annual growth rate of the cannabis market is 24%. Year over year for the next 5 years, to a point of $66 billion, which is like great. When it's good, was like, there's other things too. The educational classes, that market's projected to grow to 22 billion, from 3 billion, and that growth CAGR is in the 40%. So it's like, it's just like, yeah, it's hype because we know we can like, smell it and smoke it. It's tangible, but there are other things that are also good too that aren't as sexy or may not be as saturated or have as high of a price, pun intended.
Pun intended. Nice.
But yeah.